Hey everybody, Chuck Barone, Tuesday, August the 30th, 2022. Very interesting day. Lots of pieces to the puzzle now showing up here. We got a lot to discuss today. As always, I want to thank everybody for their support for the channel, watching the videos, all your likes and comments and questions, and all the wonderful things you guys do. Can't tell you how much we appreciate it. Special shout out to my man Greg Manarino, who keeps sending his subscribers my way. Solved our subscriber drop in one day. Greg, we love you, brother. He's actually the reason, and was the big push between me starting this channel. And I got to say, he was right and I was wrong, because I never really thought there'd be an audience from what I have to say, or that this would be any fun, and I was wrong on both. I guess there is an audience, and I am having a great time doing it. In the markets today, well, it was another one of those tantrum days. I think the markets are coming to grip with this inflation situation being real, starting to get entrenched now. The data today showing that even more. So the market, everything, another one of those weird days where everything is down. The stock market today down across the board, not looking very good. I think the growth stocks now are really going to be in some trouble. Some of these IPOs are going to get shelved. Stock market's not looking like it's in a good way. Now, the good news for the market, though, is earnings are holding up. We'll see how long that lasts, because it looks like, the Fed's work is cut out for it now. The bond market today, another down day, small down. The 10-year sitting at 3.11%. The 2-year sitting at 3.47%. And it actually was up to almost 3.5 today. The highest level for the 2-year since 2007. So that's how long rates have been suppressed by this friggin' Federal Reserve. And I thought that was interesting. The yield is all inverted, but I wanted to go back and say, okay, well, we know that this is the highest on the 2-year since 2007. What were rates on the 10-year in 2007? Well, I went and looked it up, and it said the average rate for 2007 was 4.63. So now you can see kind of where the yield curve would be if it was a normal yield curve, with the 2-year lower than a 10-year. Because typically in the bond market, the longer the yield, or the longer the duration of the loan, the longer the loan is in existence, a 10-year versus a 2-year, your yield is going to go up for putting your money at risk for longer, right? Well, with this inversion, now you're actually getting a better return on a 2-year than a 10-year, which in my mind is just craziness. Why would anybody be looking at a 10-year loan? Would you rather make a loan at 10 years at 3.11, or to the same borrower for 2 years at 3.47? I mean, this answers itself here, so this inversion is crazy in my mind. And I think that before long, this 10-year, it can't stay like this forever, guys. And sooner or later, so which is more likely, the 2-year coming down or the 10-year going up? Right now, my vote would be the 10-year going up. The dollar today up small, very small, 108.79 on the index. The dollar is still king of currencies right now. There's been a lot of talk about the Russians and, China and other countries trying to take the dollar reserve currency off. Even talk of creating a new currency to take its place. Until I see that with my eyes, I'm not going to believe it. I know some of these countries would rather not convert their currencies into dollars to buy commodities, but I just don't really see anything out there to replace the dollar right now. Would you trust your assets? Would you trust the store of value, the currency, to the Chinese government, to the Russians? Who? Maybe if the Swiss decided they wanted to, increase their currency by a Brazilian fold, and maybe the Swiss. But I don't really see anything else out there right now that's going to compete with the dollar legitimately. There may be these off-market trades going on. Russia wants to be paid in rubles, but until I see it with my eyes, a real competitor, the dollar's still going to be the champ. Metals today, you would think with the dollar not really moving, metals might have a chance to rebound, but they didn't. Gold down, $1,724 per ounce. Silver down, $18.51 per ounce. It looks like even without the dollar moving, just being at these levels is putting incredible pressure on metals. I think depending on where you're at in your average cost basis for your holdings, you might be seeing some buying signs coming up for silver and gold behind it. Oil also today down big, over 5%. West Texas Intermediate at $91.70, $91.90 per ounce, sorry. Natural gas at $9.07 for their million BTUs. It just was that kind of day, guys. Everything in the market down today. Everybody's selling everything out. Bitcoin also down today, back under 20,000. I think Bitcoin's going to probably go down and test that 18.5. We'll see if that support level holds now. The markets are crazy, guys. I think that they really wanted to believe that this inflation was going to be pretty much temporary, be something the Fed could handle pretty easily. It just doesn't look like that's going to happen. So the markets are reacting by basically selling off everything. And in economic news today, you guys need to know a couple of big reports coming out today. They're going to put further pressure on the Federal Reserve. Consumer sentiment came out today, which was a shocking number to me. It's at a 3-month high. The last month's number was 95.7. They expected 97.4, so they expected consumer sentiment to be higher. It came in at 103.2, the highest level in 4 months. I guess consumers, if you go back to 4 months ago, that was when this inflation was still transitory. And it looks like consumers are they're educated now to be ignorant. They don't want to pay attention, or the people they are paying attention to aren't telling them the truth. So consumers are out there spending money like the economy is great and everything's looking great for the future. This is going to put pressure on the Fed, man. This is going to put pressure on them to maybe, now they're going to be considering, I think, a 3/4 point increase in September, especially when you add it with economic data number 2, job vacancies today. The job market's still super strong. Job market vacancies increased to 11.2 million jobs available right now. That's more than 2 jobs per person seeking a job right now, which is putting pressure on companies to, offer incentives, offer higher pay, offer better benefits, which starts now. You can start to see, I've talked about it for the last month or so, the reason the Fed is so concerned about employment and wages, because it starts that wage price spiral. You're starting to see that happening now, where, companies are forced to wage. So here's the company and here's the wages. The company is forced now to raise the wages for their employees to keep them, especially in a tight labor market. And in doing so, then they raise their prices to compensate for those higher wages. Well, now it starts the cycle again. The employee wants more money because he's not keeping up with inflation. They boom, and it goes wages higher, costs higher, wages, costs. It just starts this spiral, and now it's starting to accelerate, especially with these job openings. It really putting the Federal Reserve in a very difficult position right now, where people believe that the economy is still going great, even though it isn't. People are still borrowing and spending money like everything's hunky-dory. And now with so many jobs available and so few people to fill them, now let's even say half of those jobs are less than desirable, okay? The $10 an hour or less jobs where it's basically starvation pay. Okay, so even if half of those are crap jobs, that's still almost, that's still 5.6 million good jobs available, and there's only 5 million people looking for jobs right now. So there's jobs out there, and it's going to, again, it just puts so much pressure on the Fed, with people spending money in the economy, just spending right through this inflation, and jobs being so plentiful. Now the Fed is going to have to step up and show us they're serious. Now, doing the big talk at Jackson Hole has spooked this market. We're seeing the results of that over the last 3 days. Now they're actually going to have to follow through and do more than talk about it. Let's see if they got the stones. Now, here's the latest head fake. Have you guys seen this? So, they're trying to say that, we're not in a recession, and GDP falling for 2 consecutive quarters is not even though that's been the basic definition thumbnail definition of a recession for a long, long time. They're trying to tell us it's not. So now they're pulling out this new index that's less followed, they say, the GDI index, which I got to admit is a new one for me. I've been following these markets forever. First time I'm hearing GDI. Well, let me explain the difference. The GDP, gross domestic product, that measures the value of all goods and services that are produced by the economy for a particular quarter, okay? The GDI, the gross domestic income, measures the income generated from the production of those goods and services. So things like payroll, CEO compensation, and corporate profits, all of that measured rather than the actual goods and services produced. Well, if you've been paying attention to the show, you know we've been telling you guys that corporations are having their highest profit margins since 1950. Corporate profits are still high and high and high, even though sales are falling. So we know corporations are taking advantage of this inflation to raise their prices, and that's what's showing up on this GDI crap. Not to mention what we just talked about with jobs, people demanding more money to go to work or to stay on a job. That's what we're seeing in this GDI. These are not necessarily great things for the economy, especially an inflationary economy, which again just adds more pressure to the Fed to tighten rates to bring down the heat in this economy. So what I tell you guys is don't buy this baloney with its GDP versus GDI, because it's just a load, it's just another deflection, distraction, head fake, whatever you want to call it, to get your mind off of what's really happening in the economy. Now remember this, guys. You know, the Fed's raising rates, and the truth of the matter is a simple one. Just raising rates on its own does nothing to bring down inflation. It just doesn't, okay? What finally brings down inflation and why raising rates is the first step, because they're going to raise rates as long and as high as they have to cause a recession. It's just that simple. You know, remember what I told you guys when they talk about a soft landing, picture the Hindenburg exploding, right? Because there's no such thing, especially in an inflationary cycle like this, okay? You go back to the history in the 70s and 80s, well, guess what? There were several recessions during that inflationary period, and what happened was, when Burns was chair, he, when the recession rolled around, started cutting rates, which drove the inflation numbers right back up. Until Volcker finally let the recession happen. It turned into almost a depression. It was really a bad time, but the politicians had the stones to not freak out about it and pressure him. They knew getting inflation down was more important. And the amazing thing about it all was after it was finished, and Volcker had done his magic, and the economy had suffered and gone through a pretty severe recession in '82. Well, that set us up with the overnight rate at almost 20%. That set us up for basically 30 years of rates coming down. So it set up refi boom after refi boom for the mortgage industry. It set up better pricing, better everything over the course of the next, until Greenspan basically put it at zero in 2000 when the dot-com bubble blew up. But this is what we're going to be seeing, guys. We're going to see rates continue to rise. The Fed has really no choice now but to bring in a hard landing. They got to get this job market under control. Spiking wages is not going to be something that's on their menu that's good for inflation. So they're going to do what they got to do to bring these employment numbers. They want unemployment higher. They want less competition for those jobs. They want wages, because it's a big part of inflation. They want those wages not growing as fast as they have been, even though they've been basically keeping everything in wages have been stagnant for so long. And now you understand why. That's how we've had the ability to keep inflation numbers so low, to keep credit rates so low for borrowers, as we created this debt economy and the debt trap that comes with it, where people literally they're born and raised, they graduate from school, whether it's high school or college, And by the time they've done that, they've probably already somehow in the debt trap with either credit card payments, student loan payments, car payments, revolving payments or whatever. There's just so many ways to get stuck in this debt trap now. And then when you start adding on rents and house payments and mortgages and all the other stuff that goes with that, these guys are doomed, man. I don't know how this is going to turn out well, guys. You're looking at, just in yesterday's report, we said 3.8 million people or households looking at eviction in the next 2 months. Okay? Well, if jobs are so plentiful and wages are going up so much, how come people can't pay their rent? How come people, we saw 60%, it's up 61%. How many people are at risk of having their power shut off? This is all, it flies in the face, the reality on the ground, where people can't pay their bills, and in such staggering numbers, flies in the face of consumer sentiment at 103.4 or 103.2, whatever. It's just, how does that jive? How does that match? It just doesn't match. So somebody somewhere is pulling our leg, guys. I guess if you're working and you're doing well and you're getting raises, the economy looks good for you. But if you're not working or you're in one of those jobs I talk about, the $10, even $15. If you make $15 an hour and you work a 40-hour week, you're making $600 a week, guys. This is not a king's ransom, okay? With rents approaching $2,000, the average over $2,000, if you're making $2,400 a month at $15 an hour, and so is your spouse at $15 an hour, you guys are, more than half of your take-home income's going just to rent. $700 car payments, credit cards, student loans added up. People can't pay their power bills. So I think that we're going to be looking at some bad stuff coming in this economy. You're going to start seeing massive numbers of defaults on credit cards. People are just going to not be able to pay those credit cards. They're going to do the best they can to max them out before that happens, though, and you see credit card debt flying right now. You're going to see more and more car repos as used car values are going up, which is just the craziest thing. I keep saying the craziest thing I've ever seen because it just seems like we live in this crazy world where up is down and black is white and bad is good and good is bad and everything's just the opposite of the way it should be. So we got real estate starting to tank. We got consumers in debt up to their eyeballs. We got people can't pay their power bills. We got millions of people about to be evicted. They're calling it the tsunami of shutdowns and a tidal wave of evictions. Wow, these ocean metaphors are wonderful, right? At the same time, they're going to tell us that there's 2 jobs for every person that wants one, and the consumer sentiment is, 6 points higher than they estimated it, which is a pretty big miss. I don't know, guys. This is just what I've been saying since the beginning, I think still holds true. Hold your money tight. Save as much as you possibly can. Set 10% as your baseline. Save 10% of your income. If you can save more, great. If you have to save less, do it. Just make sure to save something, okay? Invest your money conservatively. Now's the time for value stocks, not growth. These growth stocks are going to be the ones they're getting punished now in the market. The value stocks, utilities, dividend stocks, soaps and food, healthcare, preferred stocks. These are the stocks that are holding their own in this tough market. That's where you want to be right now. If you're in debt, do a little bit of what you can to pay that debt down. And at all costs, if you can possibly help it, do not add on new debt. This recession is going to be a tough one. It's going to last for a while. The last time we had inflation like this, it was 10 years, guys, 10 years. So the idea that we can get rid of this in 10 months is just a pipe dream. Buckle up. We got a long, tough road ahead of us. Beyond this show, we're going to give you the news you need every single day. Hunker down and take care of yourselves. Do the best you can to live within your means, and you'll get through this recession. You'll get through this okay. Anyway, Tough day today, not a lot of happy news. I apologize for that, but we really appreciate your support. Tomorrow is another big day with data coming, so we'll be on tomorrow after the close. Look forward to talking to you then. Until then, guys, take care. Thanks.